You ever get that feeling? Like you look at the headlines and they're all screaming economic boom, but then you look at your own bank account or talk to your friends and it feels, well, different? That's what we're digging into today. This massive disconnect between the official story and what a lot of us are actually feeling.
All right, here's how we're going to tackle this. First, we'll lay out the big contradiction. Then, we'll play devil's advocate and look at the case for a boom, and then the case for a bust. After that, we'll try to figure out how both can be true at once, what it all means for the market, and yeah, what you should be watching out for.
So let's get right into the thick of it. The whole issue really boils down to this. The story the officials are telling us about the economy seems to be coming from a totally different universe than the one a lot of people are living in.
I mean, that's the million-dollar question, isn't it? Is this thing booming or is it busting? And what's so wild is that you can find data that strongly supports either answer. It's like the economy has a split personality right now.
And right here, this slide just lays it all out, doesn't it? It's the whole puzzle in one place. You've got this insane 4.4% GDP growth. We're talking the best number since 2023. But then you look at the job market and it's telling a totally different story. Weakness, downward revisions. It's like two different worlds. So what gives?
Let's start with the good news, the bull case. Because honestly, there's some seriously powerful evidence out there that suggests the economy isn't just chugging along. It's firing on all cylinders. Okay, first off, that headline number is a beast. 4.4% annualized growth. For a major economy, that is just massive. But here's the kicker. It was revised up. That means things are not just good, they've actually been getting better all year. It's accelerating. And it's not just GDP. Look at what the industrial metals are doing. They're basically a crystal ball for the economy. Gold is over $4,900. Silver's knocking on the door of 100. And the big one, Dr. Copper, they call it that for a reason, it's got a PhD in economics, is just soaring. I mean, come on, these are not the signs of a struggling economy. Not at all.
Okay, but that's just one side of the coin. If you start digging just a little bit, you find some pretty serious cracks under that shiny surface. So let's flip it around and look at the stuff that paints a much, much darker picture.
The job market is basically yelling the exact opposite of the GDP numbers. We're seeing actual job losses, and the revisions to past numbers are just brutal. Take October. It got revised down to a loss of 173,000 jobs. Even the Fed is coming out and saying, hey, we've probably been overcounting jobs by like 60,000 a month. And historically, when you see job losses like this month after month, it almost always means you're in a contraction. And you don't even have to look at the government data. Just watch what the big companies are doing. Macy's is shifting its entire strategy to focus on rich people. Delta's making all its money on first-class flyers. They're telling you, without saying it, that the average person, the bottom 90%, is tapped out. So they're chasing the only people who are still spending like crazy. So how is this possible? How can we have a rockstar GDP and a failing job market at the same time? How is Dr. Copper booming while the average Joe is getting squeezed? Well, the answer is pretty simple. We're not living in one economy anymore. We're living in two. Okay, so the concept that really unlocks this whole thing is something called a K-shaped economy. And it's such a perfect picture, right? Think about the letter K. You've got one arm shooting up. That's the top tier, the asset owners, the folks doing great. Their world is booming. But then you have the other arm of the K, and it's heading down. That's pretty much everyone else, feeling the squeeze, struggling to keep up. And you can see those two arms of the K in stark relief right here. For the top arm, you've got the S&P 500 going, and I'm quoting here, absolutely parabolic. It's a rocket ship. For the bottom arm, consumer sentiment has crashed to levels we haven't seen since the absolute pit of the 2008 financial crisis. It's just two completely separate realities. So what's fueling that top arm? Well, a huge part of it is the AI investment boom. We're talking trillions with a T being spent on things like data centers. That spending goes directly into the GDP calculation, making it look amazing. And what do you need to build a zillion data centers? An ocean of copper. So that's a big reason Dr. Copper is so happy, even if you and I aren't feeling it. And there's one more sneaky thing going on, something called price rotation. It works like this. Say you used to buy a cheap little widget from overseas for $1. Now, because of tariffs or whatever, you have to buy the American-made one for $2. You are now paying double. Your personal inflation is 100%. But the official stats don't really see it that way. So on paper, things look okay. But your wallet, it feels that squeeze, big time.
Okay, so we've got this fragile, two-faced economy, but the stock market is only looking at the top half of that K, the boom part. And that massive disconnect, well, according to some of the sharpest folks on Wall Street, it's creating a very, very risky situation. And get this, the tactical desk over at Goldman Sachs just put out this pretty chilling warning. They're looking at a potential, wait for it, $210 billion wave of selling. And it's not even going to come from people. It's from the trading machines, the algorithms. See, right now, these machines are max long. They've bet the entire farm on the market going up. But they're sitting right on a nice hedge, a trigger point where they could just flip and start dumping everything, automatic. And this setup is just, it's dangerous. You've got retail investors and a lot of the big funds who are totally all in. They're super bullish, have no cash on the side, no protection. Then you have the pros. They're playing along, buying stocks too, but, and this is the important part, they're secretly building up enormous short positions on the side. They're betting big that this whole thing is about to fall apart.
Yeah, the source we're looking at calls it what it is, a classic rug pull. I mean, the playbook is as old as the hills. You help push the market up, get everyone else hyped, totally bullish, all in, and then, just when they've bought everything they can, you pull the rug. You dump your shares and leave them holding the bag. So, with the market this fragile, it's basically a tinderbox just waiting for a match. The question is, what could that match be? What are the triggers we need to be watching for that could kick off this whole selling cascade? All right, there are three big ones to keep on your radar. First, earnings. Expectations are sky high, especially for AI. If any of these companies miss, look out below. Second, buybacks. Companies buying their own stock has been a huge support for the market. If they start spending that money on other things instead, that support vanishes. And third, the big one, the job market. If that data gets any worse, the R word, recession, is going to be impossible for anyone to ignore. So that's where we land. And it leaves us with this huge, lingering question, right? This isn't just about boom or bust anymore. It's about whether an economy like this, an economy split right down the middle, is even sustainable. You know, can the stock market just keep flying, totally detached from the reality that most people are living? How long can that last? I guess that's the real question on the table.